Hey everyone, how you doing today? We have your favorite guest coming back, Anna Kelly. How you doing, Anna?
I'm great today, Michael. How are you?
I'm doing very, very well. Folks, let's try something different. I don't think I've ever done this on one of Anna's interview. Why don't you do me a favor, leave some comments letting her know how much you appreciate her weekly contributions. Let's really blow up this comment section with thanks and gratitude for Anna because she's been with us the longest and she is the original expert. So thank you very much, Anna.
Oh, thank you so much. It's my pleasure. I enjoy doing this so much, and I hope your listeners get a ton of value.
Yeah, I'm sure they do. Let's see if they do their side of the equation and post a lot of comments. This
Okay.
our topic number one today is going to be inflation, right? Inflation is something that really hasn't been something I've considered in the 20 years I've been doing this. I think it's fair to say, given the amount of money we printed last year and this year, and maybe created is better than saying printing. Um, I think it's something we have to consider. Is it simply going to be, the Fed mandate of 2.5? Is it going to be more severe 4? Or, some people are talking hyperinflation, which I think is just a scare tactic. But I mean, inflation is a consideration today. So I was wondering what you think about it.
Yeah, Michael, it is such a complex topic. And I will start by saying, and I think I've said this before, and you always make me feel better about myself after I say it, but I'm not an economist, right? And so, but I've studied the economy a lot, and I have studied things like inflation and deflation and risk and things of that nature, and how real estate can kind of hedge that. But there's a lot of people a lot smarter than me in this, and guess what? There's like 10 different answers as to what's going to happen, no matter how educated and smart these economists are. There's disagreement, right? And so I'll preface this with saying, does any of us really know what's going to happen? I think the answer is honestly no, right? Because we're in such a different phase of economy right now, and there's so many things converging that we don't have a historical past to look at and say, this is what's happened in the past, and this is how we're going to get out of it, and this is the result that happened in the past, so we can bank on something cyclical like that happening again, right? We see things from the past, and we can say, if things work out like they did last time, if the government reacts the way they did last time, maybe these things will happen, right? But there's so many unknowns that I will say, I think I have a pretty good idea of where things are going and some things I'm looking at in terms of how I'm trying to hedge my investments. But do I really know? Probably not, to be honest with you, right? So I just want to throw that out there, and then let me know what you think about that statement, and then I'll talk about what I think is going to happen.
Yeah. So first off, always appreciate just the level-headed nature, right? But again, we are investors, right? We're putting hundreds of thousands, if not millions of dollars to work in an environment where we could get deflation. We could get asset price deflation, right? That's one of the outcomes that's out there. We could see huge inflation, both in asset price and consumer products. So I did study economics, did get an MBA. So it's kind of what I've seen from economists is they always declare what kind, like Janet Yellen's a labor economist, right? So she's all about full employment. Every economist I've known has their thing, and mine has always been the consumer.
Yes.
The consumer is 68% of the economy. If you can figure out what 68% is doing, the other 32% comes along with. That's just how I've always been. So what I see coming is I see demand pull inflation coming, because the consumer has done one thing historically that I can count on, is they've always spent. Yes, we've had moments of retraction, like 9/11, like the Great Recession. 9/11 was really a retraction of about 90 days. The Great Recession was like 9, maybe 12 months, depending on the variables. This one's probably going to be 15 or 18 months, but that just means the spring back out of this, which probably starts in earnest in April, maybe May, is going to be something to behold, in my opinion. Now, how does that ripple through? I think supply chains get, a little beefier, right? We have problems with like can you believe car manufacturers don't have chips to make cars today? I mean, That's one of the supplies.
Oh,
Lazy Boy just announced they have a supply chain problem making recliners.
yeah.
I mean, there are real issues out there. So I see copper up, gas up, lumber up, cement up. And then we're going to throw in a infrastructure bill, which I think is going to be 4 trillion plus. I don't know how we don't get, CPI based inflation. Where I'm trying to scratch my head is what happens to asset prices? Because
Yeah.
asset prices, the top end of the K got huge run the last 12 months. Does it go another 12 months? Does it retreat as the consumer comes back? I mean, there are so many cross currents going on. It's going to be interesting to watch.
100%. I am on exactly the same page as you, Michael, because when people throw out blanket statements like we're going to see stagnation or deflation or hyperinflation, it's a blanket statement and not everything behaves the same way, right? So one of the things that you said in the beginning is the government going to try to keep their 2% inflation, right? Well, when the government looks at monetary policy and they decided they're going to keep rates low or rates high, they want to keep rates low so that you continue to buy. You continue to buy things for your house. You continue to expand your business and take a loan. You continue to buy houses and take a loan. Because if they can get you spending, right? If they can get you spending, then they can rely that eventually, because of spending, you're going to have some inflation. And they want inflation, they say, to be 2%. But here's the thing. What inflation rate are they talking about, right? So you've got the inflation rate of the dollar, what's happening to the value of the dollar, but then you have consumer price index. And, even though they say they want to maintain an inflation rate of 2%, so they don't want hyperinflation, way higher than that. They don't want deflation where that goes down. Consumer price index inflation is usually about double that. So they say it's like 3 to 4%, right? But when you look at like a certain basket of goods that's most consumed by the American population, real inflation by many economist standards is really closer to 5 to 6% in terms of how much are we really getting for the dollar that we spend. So while wages may not go up 3%, the cost of all goods might not go up more than 3%. The cost of bread and milk and gas and oil and all those other things that we really need and spend a lot, the real inflation on those things can be 6, 7, 8%. And then, oh, by the way, you throw in this supply chain interruption where we're not able to get goods, or we look and we realize that even our American manufacturers are getting parts from China, right? And when we have these tariff issues and taxation issues and can't ship things here, if we're not making them, the costs of all of even the American-made products that use some foreign, parts or just have a supply chain interruption, they're going to make the inflation for those goods significant, right? So there's different inflation, and that's where then you say, well, how is all that going to converge and impact the value of my assets? And I think that's what we're all trying to figure out. Like, what happens to the dollar? How do we hedge against the value of the dollar deflating such that it can purchase less? The purchasing power of the dollar goes down when we talk about inflation. So when the government's printing all this money, everyone's saying they're printing so much, it's going to devalue the dollar. What that means is every dollar we have can purchase less because it's the dollar's worth less. But at the same time that happens, Michael, consumer price index, the inflation of the cost of goods, can go up significantly, even if the value of the dollar goes down. And our assets can go up significantly, even if the value goes down. And historically, that's what happens. And so there's so many things, and I think we just have to tick each one of those off as we talk about what really happens.
Yeah, I mean, there's so much going on. The one thing that I've been playing with, because I just completed a commercial refi, right? One of my apartment buildings, and I got the longest term possible, right? 10 years, right? Little higher rate, 10 years. Because when I look at all the things that are possible, I didn't want interest rate risk, right? Because one of the outcomes is, okay, the 10-year treasury gets disconnected from what the Fed is doing on the short end. That then impacts banks lending on the 30-year, and my rates go up substantially. So,
Yeah.
I guess I'm curious, when you look at commercial properties today and you're thinking about the refi or the reset time frame, are you calculating interest rate risk for the first time? Because 20 years the rate's been going down. It could be going up.
100%. And I started really thinking about interest rate risk when the market started to crash at the end of 2008 and the beginning of 2009. I thought rates are going to skyrocket, right? Because banks are tightening up. They're not giving loans. They're printing all this money. They're giving all these bailouts. There's houses in foreclosure. Rates are going to go up. And I had a loan that was going to be coming due, 3 years later. And I called my bank and said, can I just lock in, like rates went down, can I lock that in for the next 5 years? And I paid to lock my rate at, I think 5.25%, Michael. I paid like $3,000. Well, what happened to prime? It went down to 3.25% and it stayed there about 10 years. So I tried to hedge the risk of rates going up, but to my surprise, interest rates never really ticked up. Prime stayed at 3.25%, right about, for about 10 years. And it wasn't until the end of 2018 that rates started to trick up. And what happened when the Fed raised the prime rate, which then raised all the other rates, especially for commercial, because a lot of commercial rates are based on prime plus a spread, right? All of a sudden the economy started to teeter. And it was like within 2 months of raising prime, because the government thought, oh, we're back into a equilibrium, we can raise rates, right? They quickly had to reverse course and cut rates again because the economy wasn't as stable as they thought to sustain those rates. So I was wrong 10 years ago when I thought rates would go up. So the question is, are interest rates really going to go up over the next several years? I think they have to, Michael. I don't think we can stay with basically 0% Fed funds rate and a super low prime with as much money as we're printing. We're printing a lot more this time than we did in the Great Recession. The question is how long, right? And so for me, 2 years ago, I thought rates are going to stay, in the 5% range. Well, I locked in some rates excited to be at 5.25%, and then they dropped. So when the pandemic hit, I called all of my lenders, and I just have a few commercial lenders that I work with. And I said, listen, I'm not going to ask you for a forbearance. I'm going to be faithful to pay. I've got a lot of cash reserves to make sure that even if this gets bad, I'm okay. But in exchange, I want you to lower my rate, even though I'm not due for a reset for 4, 5, 6 years. And so I got the banks to lock in my rates low, sub 4, on almost all of my loans for at least another 5 years. And on the new debt, I had a choice of 5, 7, or 10. I chose the 7-year option. I ran the numbers and I picked 7 in between. So I'm not paying another 1/4 point for 3 more years of a low rate. I thought I'll just save more money, right? And if I need to essentially cut my interest rate, I'll just make a bigger payment, which will reduce the interest that I'm paying on the principal that's left.
Yeah, makes sense. So the other thing about inflation, again, a lot of people throwing out kind of 2 countries, and it'll make sense in a minute, right? On the hyperinflation side, they talk about Germany, and then on the other end of the spectrum, they talk about Japan. I think hyperinflation in the U.S. economy, as long as we are the reserve currency of the world, is crazy, right? Hyperinflation defined as something 100% or even 50%. But if we talk about inflation at north of 5%, being rough for the US, I think that's possible. And then I think, we could be here for 20 years like Japan. So, I don't know if you've studied or looked at either of those scenarios at all, but I'd be curious what you think of those 2 options.
Yeah, I have loosely a few years ago. I think that, like you said, I don't think we're ever going to go into that level of hyperinflation. One of the big red herrings is, do we maintain the reserve currency of the world? There are a lot of countries in the world and in the UN and the International Monetary Fund that have been pushing to change the reserve currency to not be the US, but a basket of a certain currency. So you've got the BRIC nations. I think it's Russia, India, China, and is it Brazil?
I think so. Yeah.
The BRIC currencies. And so they've talked about switching to, that as the reserve currency. If that happens, I think we could see a big devaluation of the dollar, right? And the question is, what's the probability? I don't know yet, but it's definitely higher probability than it was a few years ago, right? So I think we have to realize that there is inflationary risk, which means a devaluation of our dollar, increase in our cost to purchase goods and services. But it also means that if goods and services are more expensive, as long as there's not legislative interference, right? My asset prices go up and so do my rents. So by having real estate at all, rental property real estate, any real estate, we have hard assets that if we do hit a period of inflation and increased costs, our assets are just going to get more valuable. And so I'm not as worried about inflation because I know that the value of my assets are most likely going to go up at the same time. What I'm more focused on is if that happens, how do I hedge my legislative risk that I can't raise rents to keep up with the increased costs? That I might have to sell the properties and not be able to get the great tax benefits, right? So those are the kind of things that I'm thinking of, like not, oh no, inflation's coming, what are we going to do? It's, well, everything's going to be more expensive. And so everything I make is going to go up and my net worth is going to go up at the same time. How do I hedge the legislative risk and buy properties that have less risk that the government's going to intervene and keep me from raising my prices when the cost of everything else goes up?
Yeah. This is always fun talking about real world, because again, we're still making investments and we have to think about these things. Again, an interest rate risk is something I haven't considered in 20 years. So it's
right.
pretty
Right.
interesting.
And one benefit that you have, Michael, investing mostly in single family homes is you can get 30-year fixed mortgages in some instances.
Absolutely.
So I have used very little of the traditional conventional financing for single to four families. You can have up to 10 in your own name with 30-year financing. Historically, I've just gone straight to the commercial lenders because they're so easy for me to do business with, and just, did 20-year mortgages with 5-year terms, sometimes 7. But I will tell you that as I'm starting to hedge my bets a little bit, I've been buying vacation rentals. I'm using up my, Freddie Mac, Fannie Mae, 30-year conventional financing on 1 to 4 unit properties where I can lock in that rate for 30 years. So locking in your rates as long as you can is one of the best things you can do to hedge inflationary risk.
Yeah. And that's exactly what I'm telling, new investors to focus on residential, right? Usually it's single family homes, but obviously it's fourplexes and below, because 2021 is going to be that year where the Fed can keep rates low for a year, right? They have the wherewithal to do that. Who knows going forward? So rates will stay low. There'll probably be 2s and 3s this year. And you can get in before inflation really takes off, because we won't see true inflation, even if the economy retail sales this morning up 5.9%, and it was expected to be up 1.2 for January.
Right.
So we are coming back, but that won't even, that won't hit, the Fed's radar in any meaningful way until next year. So this is the year. You want to buy a single family rental, get your 30-year money now, get in before inflation, do your work. Let's go.
And the other thing just to throw out there that's, I think, really important, if you've listened to us talk before, Michael and I are not an advocate of, tons and tons of leverage, right? But you want to use leverage wisely. And the thing about an inflationary period is if we have inflation, if you buy properties all cash, not only does it create opportunity cost lost, right? Because you can only buy one property instead of putting 20% down and buying 5, right? With the same money. But what happens is if you buy cash, people think, I'm just going to put all my cash and I'm going to pay cash. The inflationary risk is now yours. So every dollar of equity that's stuck in that house is having inflation eat away at its value and its purchasing power. So your $100,000 investment today, if we have inflation, 20 years from now, that might only buy what $50,000 today would buy, right? Yep. By getting a mortgage for 80%, and I suggest most people get an 80% mortgage, 75 if that's the most you can get. it allows the bank to be the one that's taking that inflationary risk. So
Mhm.
their money's devalued. And as our values go up and our rents go up, our payment's the same at today's dollar, which is less than what it's going to be worth in the future. So use leverage to your advantage to hedge some inflationary risk and spread your cash amongst multiple different properties, where even if one went down in value, the other four are going up in value.
Wise words from Anna Kelly. Thank you very much.
Thank you, Michael.